$1,251. That's the amount my mom paid for a managed account at Chase every year. When I found out about this, I was furious. The biggest lie in the investing world is that you need to pay a professional to manage your investments because you're too dumb to do it yourself and they can do it better. Like most people, she didn't understand the deadly effects of fees. John Bogle, the founder of Vanguard, describes high fees as the silent killer of investment returns. By the end of this, you'll understand what a managed account is and just how expensive it can really be. You'll also find out the dirty little secret investment managers don't want you to hear and a better path to financial freedom. First of all, what is a managed account? It's as simple as it sounds. You own the account and a professional investment manager invests for you. They decide what to buy and sell inside of your account based on things like your needs, risk tolerance, and goals. Often, these accounts require a large starting investment. In exchange for their time and the service, you'll pay them a small fee of 1 to 2% of your account balance every year. If you have $100,000, you pay them $1,000 every year, no matter how well or poorly they do. 1 to 2% per year doesn't sound like much, but the average market return is only about 10% per year. So you're basically giving up more than 10% of your profits every year. This 1 to 2% fee is in addition to the fees of any mutual funds you have inside of the account. Most managed accounts hold a variety of mutual funds. If these funds charge you a total of 1%, then you're basically paying 2 to 3% per year. Ouch. Some people think, but you get what you pay for, right? That depends on what your goal is. If you're hoping that these professionals will pick investments that will do better than the rest of these suckers, I've got bad news for you. Over the long term, active management fails to beat passive management, like just getting an average market return from index funds, more than 80% of the time. The biggest reason? Bogle explains that as investors, we will always do worse than the overall market because we have to pay companies like Fidelity for their services. At its core, the stock market is a trade between two people, a buyer who thinks the price will go up and the seller who thinks the price will go down. They can't both be right here. The chance of winning is basically 50-50, right? But that's not accounting for the fees that these managers charge. Once you account for that, it's less than 50-50. How much less? It depends on how much they charge you. The more they charge you, the less likely you are to win. If they charge you 1.5%, you're starting off at minus 1.5% while everyone else starts at 0%. You're already behind. In other words, they must beat the market by 1.5% just to break even and for you to catch up to everybody else. Doing this for 1 year is hard, but doing it consistently, year after year, is nearly impossible. It's like the Olympics. How many people can actually stay in the top 3 year after year? While it is true that some do win medals year after year in the Olympics and some do manage to beat the market year after year, how do you know who's gonna win beforehand? You don't. I know, I would just look at the fund's past 10-year performance and pick the best one. But is that such a good idea? Let's see. JCPenney had a remarkable performance for almost 2 decades, from 1982 to 1998. Its share price went from $6 to $78. Let's say you invested in 1998 because the past performance looks so good. Your investment will only be worth $10 per share a few years later. To make matters worse, since literally a monkey could buy a stock nowadays, beating the market might actually be a matter of luck and not skill. If someone flips heads 10 times in a row, do you call him a genius? However, there are some rare instances when a managed account can be useful. If all of these apply to you, you can look into one. 1. You lack basic investing skills. 2. You don't have time and don't care about getting below average returns. 3. You let emotions drive your investment decisions. If they don't apply to you, skip the managed accounts. They're too expensive and most don't do very well. Instead, you should invest on your own using something like an index fund. However, this is only one part of the equation. Another part is learning how to diversify. Since no one knows what the future is going to be like, you must diversify across different asset types like bonds and real estate. As the legendary investor Ray Dalio once said, "He who lives by the crystal ball will eat shattered glass." If chomping on glass doesn't sound appetizing, you should check out this next video to see how one of the best investors in the world diversifies. If you haven't already, make sure to subscribe.